Hi, everyone. Welcome to Signal or Noise, new show, episode 1. I'm Charlie Bilello. With me, Peter Mallouk. And together, we're going to go through the markets, the economy, investing, personal finance, and much more, and try to help you separate the signal from the noise. Peter, how's it going?
Pretty good. It's I love about just putting episode one out there is whenever we get to episode, 30, 40, everyone goes back and looks at the first one and how many things were screwed up in that first episode or all the lessons learned.
Yes.
So I love that you just put it like on slide one, right in the middle to let everybody know
Here
we're
we
trying.
go. All right, it's
Here
going
we
to be
go. Let's just do it.
expectations are very low. Exactly. We're going to exceed those. So, let's start out big topic last week. Bank of Apple, Apple jumping into the high yield savings game, 4.15% yield. You have to have their Apple card, so they're pushing people to get that Apple card. Just in my view, a pretty smart move. They're trying to get everyone to be on their phone, of course, all the time. And now you have the watch, the phone, the iPad, the Mac. Apple ecosystem just continues to grow. What's your take on this, Peter?
Just typical Apple genius. Like, so they don't want to be in the money management business because they're going to make a lot of people mad and lose that kind of perfection image. But making money on cash, I mean, that's an easy business to be in. And it sounds like a high yield. You and I know there's ways to get better yields, but what Apple, I think, the brilliance of Apple has been about taking the complicated and making it look easy, right? They didn't invent the phone, the smartphone. That was Palm, BlackBerry, all that stuff. What they did was they made it visually appealing, very organized. Anybody could figure it out, and that's what took off. And that's what they're going to do here with money. It's so much easier than going to a bank or figuring out should I be in T-bills or CDs or money market or what should I be doing. I mean, this
Right.
is going to be a grand slam, and a ton of people are going to sign up for their card, and it's going to be another huge profit center for them.
Seems to be the case. Pretty simple. And so, why are people doing this? Well, why do people care now about yields? Well, simply the Fed has been hiking rates. Everyone knows they've been hiking pretty much every meeting over the last year, different amounts, and they're expected to hike again. So this yield on short-term savings is likely to continue to go up here. They're going to hike at least one more time if the market's right. They're expecting close to 90% chance at the next meeting. That's in early May. And what the Fed has done historically is what the markets expected it to do. So if we get closer to that, and these are the odds, seems pretty likely the Fed's going to do that. And as you said, though, investors, they could go out and buy 3 month treasury bills, but the ease for consumers, they already have their Apple products. They like it. They trust Apple. And if they could bump that yield up from zero, which is what people are getting in their checking accounts and many savings accounts, up to a little over 4%, that's pretty good. And so there's just a ton of options now for consumers and investors in terms of where to get yield that's higher than 0%, right? You could go savings or short-term CDs if you want that FDIC insurance, which I guess if you're at Silicon Valley Bank or Signature Bank, you didn't end up needing got that bailout. But you also have money market mutual funds. A lot of people use that. If you have a brokerage account, you have just treasury bill ETFs, and more and more people are going directly and buying treasury bills from the Treasury Direct website. So a million different ways to do it. All these are good. You obviously want to get a higher yield than 0%, but the simplest for a lot of people, and they're on their phone, right, hours a day. And so it's just simple and to see everything in one place. So it seems like Apple is going to do pretty well with this product. We'll see in the next few
Apple's the
months.
easy button. Game over. I mean,
Yeah,
it's just the easy button.
pretty simple. All right, so let's talk about something a little controversial here about the Fed. You have a lot of people who either support the Fed, don't like the Fed, but here's a proposition I have or a question. Uh, why do we still we're in a capitalist economy? It's running pretty well. Most areas of the economy, you don't have this central planning, right? That's pretty much a feature of the U.S. economy. It's been a great feature. It's one of the reasons why U.S. economic growth has been tremendous over the last 100 years plus. And it's just strange to me that we have this antiquated system where 10 people sitting in a room, Peter, are determining the interest rates, which is very important, obviously, in the economy for a $26 trillion economy. Does that still make sense today in 2023?
So I'm going to surprise you with this. My answer is yes. So I'm eager to hear your take on this. My answer is
Yeah.
yes. I think that we've learned the hard way that you just let the free market go here, you basically have the decisions in one sector, in the financial sector, can often create a situation where it impacts everybody else in America and frankly on planet Earth, because when America sneezes, the world catches like a cold, right? And so you basically have a crisis that can happen in a couple brokerage houses or a couple banks, and all of a sudden it bleeds into everything else. And we do know that there's a couple ways to speed up a recovery, and it's monetary policy and fiscal policy, whether it's Congress's policies or the Fed. And the Fed can go, look, we need to get people back to spending money, get the economy going again, give people some confidence back, and they can do things like put money in the system or lower interest rates to speed that up. I think the problem is the extent to which they make tremendous mistakes is just staggering, right? Like if you look at all of the stimulus that went after COVID, when really with COVID, everyone was just inside. It was like there was a blizzard and you're stuck inside, and the blizzard's over and everyone's willing to go outside. They did not need all of this stimulus, which got us into this inflationary problem that the Fed is now having to try to fix their own problem. But I think despite all of that, we do need, I think maybe we don't need it, but I think we benefit overall from having this system in place. I think there could probably be better controls in place here, and maybe higher triggers for their involvement. But I do think overall we're better off. Charlie, how about
Yeah.
you?
I think we should probably separate out the Fed's regulatory role, right? I think we would all agree that there needs to be some regulation in banks, just how critical they are to the system. So that's vitally important. Doing away with that, you're a real libertarian at that point. Let the free markets, go to work. That could lead to big problems. My issue is in terms of the setting of interest rates and the Fed's balance sheet, right? Like the Fed, much like politicians, they're incentivized to ease, right, over tighten. And for a long time, people said, well, what's wrong with that? Why shouldn't you always ease, right? What's the downside to the Fed doing these actions? And now we're finally starting to see
We see
that
the downside.
via
Yeah.
inflation, right? So they have this bias towards being easy. After the financial crisis, they took rates to zero, right? And we could debate whether that was smart or not smart. But then what they did thereafter is they held them at zero for 7 years, right? Normally, during an expansion, you start to increase interest rates, or you start to normalize policy. They chose not to do that. And the reason that Ben Bernanke gave was he said that we want to have a wealth effect. We want to drive up asset prices so that people will spend more money. And it sounds great, right? On paper, the problem with that's inherently inflationary, right? And pushing up asset prices, yes, makes people feel good in the short run, but then it could lead to bubbles and lead to bigger crashes on the way down, right? And so you have this situation where they're supporting and propping up the U.S. housing market, which to a crazy degree, I would argue, during 2020 and 2021. So here's my biggest argument why human beings shouldn't be in charge of buying these additional securities, not just regulating banks, but they're buying mortgage-backed securities in the midst of a housing bubble, essentially. Yeah. We're seeing that Case-Shiller index go up every single month, and the Fed is totally ignoring that and pushing interest rates down to record lows. Right? Did we need that? Was that necessary to push interest rates on the 30-year mortgage bond below 3% when you had prices going up crazy amounts, 40% increase in home prices in 2 years?
I think that coming out of 08, 09, I think that those low rates stayed in place, I think, because the economy was just growing very slowly. We were seeing no signs of inflation. It felt a little more fragile. What happened after COVID is unbelievable. I think they're going to study this in economic history books, decades and maybe 100 years from now, because it was the first time where in my mind, the first time in modern history where you saw truly unexplainable support from the Fed that, to your point, wound up creating a problem that didn't need to exist.
Yeah, yeah. And if we look at the money supply, and this to me is one of the biggest issues that caused inflation. It's very fascinating to me that if you listen to these, it's almost hilarious. You listen to these Fed conferences, and this question is never asked, Peter. It's really fascinating. No one ever says, "Well, why did you increase the money supply 40% in a 2-year period?" and think that that wasn't going to have an impact on inflation. Now, thankfully, that's coming down, and that's helping inflation come down. But it's fascinating to me that that would be the case, which to me, a compromise to me would be, let's maybe agree on a formula based on inflation, based on unemployment rate, something like the Taylor rule, where it's more systematic, right? We have all of this data, we have AI, we have all of this technology, but yet human beings are reacting to lagging data to set interest rates. It seems kind of crazy to me. I'm not alone. So I did this poll out on Twitter, and maybe that's because they follow me. They agree with
Right.
these sentiments. So there's some bias here, but 78% said, let the free markets determine that. I don't think it'll ever happen. It's not just the U.S., by the way, right? It's globally. You look at Bank of Canada, you look at the ECB, you look at Australia. All of these other countries that are supposedly free market capitalist economies still have this system, but it's kind of bizarre to me, and I'm not sure it's optimal. And I think it leads to a misallocation of capital and resource. And you're essentially betting that these human beings are getting it right when we've seen Fed policy really caused three bubbles in the last few decades. The tech bubble, with Greenspan put and cutting interest rates in 1998. You had the housing bubble with the Fed cutting rates to 1% and leaving them there after the 2001 recession, and that helping to fuel the housing bubble. And then now you have the same situation today with the Fed being ultra easy. So
Well,
we'll leave it
getting rid of
there.
them is not, yeah, getting rid of them is never happening.
No,
And
right.
like you said, and so I think we can agree some parameters would be nice because they do cause more harm than good quite
Yeah.
often. Yeah.
So I guess, yeah, right. I guess ultimately it should stem from the people. And if the people now have observed that the Fed has failed them in terms of doing their primary mandate of controlling prices, then maybe Congress should rein in some of these powers going forward. We'll see. I haven't heard that proposed yet, but perhaps that's coming. But let's talk about another interesting, maybe controversial topic. But to me, it's pretty fascinating to see really the divergence between how businesses have reacted in the past year versus governments. Pretty much every day, right, Peter, you hear a different tech company, a different layoff. You're talking about cost cuts, and pretty sizable now, right, across the board. Twitter obviously being the biggest, but these companies are right sizing, right? They expanded too much. Their revenues growth has declined, right? A lot of them are seeing outright declines in net income, and they're accountable to their shareholders, right? Ultimately, their primary objective is to maximize shareholder value, and investors have been really rewarding these tech companies with higher prices this year. They're bouncing back, still not back to their previous highs, but bouncing back. And we have this amazing contrast going on because at the same time, the US government just continues to do what they always do, which is spend more money. And in the last 20 years, if we look at government spending versus consumer prices, it's just an enormous gap. So you're looking at 5% per year increases in government spending versus a roughly 2.5% increase in consumer prices. So the question is, to me, why isn't there any discipline whatsoever when it comes to the government? We're seeing widening deficits at the same time that you have companies doing the opposite.
I mean that the companies is easy, right? So companies, you've got a fiduciary liability to your shareholders. Everybody wants to make more money. You're going to hire people if you think it will help you make more money, and you're going to terminate people if you think that it's going to help you make more money. You're going to do whatever's in the best interest of the business becoming profitable. And every
Yeah.
quarter in a publicly traded company, or if you're private like Twitter, I mean, you've got an owner that cares. There's just a lot of self-interest that's aligned
Or just
with
staying alive, right?
yeah,
Too,
or
right? I mean,
just surviving. I
we don't
mean,
have
everyone is aligned in terms of the people you're supposed to have because you want the shareholders to do well, you need the company to do well, you need you can't be Disney World and not have people working all the rides, right? You have an incentive to hire, and you have an incentive to terminate people that don't add any value. And the government does not have that skin in the game factor, right? So the people that are making
Mm,
the decisions, a lot of people view this as a political thing. It's not political at all. Your
no.
graph showed very clearly, Democrats, Republicans, it doesn't
Yeah.
matter who's in office. They
Yeah.
will spend more than they take in.
Pre-COVID, we had
Yeah,
Republican
yeah,
president and
right.
deficits were increasing, right? And
Yeah.
now the opposite, right? So, but same,
Exactly. It's
yeah,
the only issue is what's the money being spent on, right?
yeah,
It's not that one party is going to spend less than the
true.
other or be smarter with it. It's what's it going to be spent on. But I think the issue is if you're a politician, your goal is to get reelected, right? And you are not going to get reelected by spending less on the things your constituents care about, whatever those things may be, whether they're
Yeah.
social programs or defense or whatever. And the good news is you don't have to pay that bill, right? Like you really do get to spend the money and then have someone in the future deal with it. And that's, there's a
Let the
saying,
next administration
yeah,
worry about it. Why
it,
take the blame from right? So right now, if we weren't doing this massive deficit spending, obviously economy is going to be slowing down, and from that, and that party in power is going to be blamed, right?
that's right.
And
Yeah.
no one wants to have that on their
You get
watch.
the
So
reward, you don't get the cut. Where is the incentive to right size anything from a defense budget to Social Security? There is no incentive. As a politician, you have all downside and no upside, right? And so until we create something that what the parties need to agree on is some kind of real control on how far a deficit can run, right? Where they're forced to compromise, and we don't have anything like that remotely on the horizon.
yeah, it seems like to me, I think this is going to be front and center, more at least more front and center in 2024 with the election coming up there in terms of the interest expense. So for a long time, there was a lot of people saying that don't worry about government debt because interest rates are so low, right? And similar
Right.
thing they would say about various
Your
other
mortgage. Yeah.
situations. Yeah, all right. Don't worry about it. Like housing prices are really high, but it doesn't matter because mortgage rates are. Well, what happens when that isn't the case anymore? Well, then it becomes a problem very quickly. And here we're seeing the interest expense on government debt going up to a record high 800 billion. This is likely to go over a trillion. And now you have the situation where this is going to be the single largest component in the federal government's budget
Right.
not too far from here. So ahead of Social Security, it's going to be the number one factor. And why that's a problem, Peter, should be self-evident, but it's going to crowd out other spending, right?
Right. And just for just a person, just like a lay person, I mean, just think about your household and you've got your mortgage and you might have a car payment, you might have a student loan payment, you've got food, clothes, kids, diapers, all that stuff. And imagine if at the beginning of every month, the biggest bill you were going to have that month was your interest payment on your credit card. It was going to be bigger than your mortgage. It was going to be That's where we're heading inevitably in the coming years, and it's a problem that, like credit card debt, compounds itself. And so we're going to find ourselves in a situation that's going to force an outcome. But it's going to, unfortunately, with democracy, the way it works is it has to be a ultimate imminent crisis, because then it's in the best interest of the politicians to say, oh, I did these things to save everything, to save Social Security,
Yeah.
Medicare, and defense budget, and all those things.
I would have thought inflation would have been the thing impetus, right, to try to control that, but so far I've been wrong about that.
It's
I would
not a,
have thought
Charlie. It's not enough in a democracy for the car to be heading for the cliff in that
it
direction
has
and even accelerating. You have to see the cliff. You have to see the cliff in front of you and have barely enough time to like wipe out and break right on the edge for it to be in the politician's best self-interest to make the changes necessary.
all right, well, that doesn't give me hopefully that's not past the point of no return.
Right.
But I guess this is something we're just going to continue to talk about in the coming months. But talking about wealth killers, and you talked about the if the biggest expense someone has is their credit card, that's going to be problematic for a number of reasons. But you put out this tweet that I thought was great, talking about top five wealth killers, and interestingly, right, there's nothing about investing here. There's nothing about like picking the wrong fund or index, right? It's personal finance comes first, right? And I thought this was a great list.
I appreciate that. I mean, a lot of people always they want to talk about which investment will do better than the other, and in personal finance, building wealth, you're talking to somebody who's getting started, when I'm talking to my kids, or I'm talking to, say, a young doctor that's starting out, and they're trying to figure out, well, what are the steps to take? These are the
Yeah.
things to start with. Don't let the credit card. You can't wake up and have double-digit interest rate expense
It's
hanging
the
over you.
number
You
one
can't make.
question, right?
Yeah,
Do you have credit
right,
card debt? If you do,
right.
start there.
Yeah,
And
you don't need me
right
yet,
now,
right?
that's a
Don't.
pretty good return on your.
Right.
Where you going to get 20%? So speaking of credit card interest rates, 20%. That's a record high. How are you going to find that type of return in the market? It's
And
just
that's the simple way to look at it. If no matter where you are in life, if you've got debt that is more than what you can earn, you should be paying off your debt. It's just that simple.
yeah. So you also mentioned car loans there and people stretching, right? It's everyone wants to have a nicer car, and if you can afford it, that's fine. And it's just becoming obviously more difficult now with used car loans and new car loan rates going up, and most people finance the purchase of a car. Cars are becoming very expensive, especially last few years. Over 80% of people finance that new car. And now you have this situation where the monthly payment is going up very rapidly. And this would have been unheard of or relatively unheard of just a few years ago. But now more and more people are spending over $1,000 a month on their car payment. And again, if that's within your budget, that's fine. But I suspect for a lot of people, it's not. And I guess it just, you have to take a good look and see, really, can I afford this, right? Which is,
I mean, this is
not
absolutely a crazy
fun,
chart.
but yeah,
I saw you tweeted this. I mean, like 4% of people were paying over 1,000 a month for a car before COVID,
yeah,
and now that's more than quadrupled. I mean, it's just absolutely an insane statistic. And you can kind of feel a debt, bubble coming just from this chart combined with where mortgages are heading.
yeah. I've been wrong, I think, about the used car market and thinking that it would come down. It's come down, but not as fast as I would have thought. And it's not, now it's starting to trend up again in terms of pricing. So there are still some inflationary pressures out there that seem pretty sticky. And you
I
have
think the
this
used car
supply.
market, yeah, it's kind of like the apartment market. I mean, the reason the demand is persisting is because the new car is so expensive. I mean, it's
Yep.
creating more demand for that limited supply in the used market.
No question, no question. And last, we have to talk about housing, right? And same situation there. And this is the single biggest cost for most American households, either rents or home mortgage payments. And just recently, a few months ago, it hit a record high in terms of unaffordability. So the percentage that you need to spend to buy that new home that's for sale, because prices have gone up so much, 40% in 2 years, and because interest rates have spiked right from under 3% to over a little over 7%. That's led to this really affordability crisis where it's tempting for people. You still want that home, but in terms of the percentage of your income, it's just gone up, and it's very hard to kind of delay that purchase, waiting for this to improve. But that's part of what you're talking about there in terms of wealth killer, getting into a home that is unaffordable based on your current situation. And Peter, keep in mind, right, too, this is in an economy where the unemployment rate's near a 50-year low, right? So what happens when people start losing their jobs more than tech? Well, if you're in a house where you can't afford, that becomes obviously real problematic very quickly.
Yeah, the thing that has saved everything is the fact that unemployment has stayed under 4% through everything. Just the luck of what's happening with immigration and demographics and the boomers and retiring. I mean, that has really kind of been supporting all of the mistakes that the Fed has made along the way and that Congress has made along the way. The unemployment rate has so far saved the day.
Yeah, it's just a shortage of workers still, and we're working that off, it seems like,
Yeah.
every single month. All right, so let's end with signal or noise. I got a few topics here, and I'm just going to let you go to work here, and then I'll give you my view. Yield curve spreads, signal or noise?
I think usually it's a signal, but I think right now things are so volatile and there's so much uncertainty. I'm going to go with noise. This would normally be something that I would actually view as a signal. I just don't think the market can predict with everything going on what's going to happen.
Okay, I'm going to take the other side. I'm going to say there's a signal here, and the reason being is this time is not different. We've seen pretty much every recession in the last 50 years be preceded by this inversion of the yield curve. And just quickly for viewers here, why does this matter? Why do you tend to see that short-term yield? So in this case, the 3-month yield is over 1.6% higher than the 10-year. Very unusual, right? You usually see investors demand more for that longer-term yield. Makes sense. If you're going to lock your money up for 10 years, you want a higher yield. And we have this weird situation today where short-term yields are higher. So why has that historically been a good signal? Well, there's a few different reasons. Number one is the market, and maybe they're wrong here, maybe that's what you're saying, but the market is expecting the Fed to have to cut interest rates at some point in the next few months. And that might seem crazy given inflation and where unemployment is, but that is what the market's currently expecting. And that's what you tend to see entering a recession, right? The Fed will cut rates and try to ease policy. So the market's looking ahead saying that. And also, you tend to see the long end fall when investor expectations for future growth and inflation fall. So investors are saying growth rates are going to come down, looking at longer term inflation rates are going to come down, and that's driving investors into that 10-year security because they're saying future growth is going to be lower. And if that 3-month treasury bill is going to be cut, if the Fed's going to cut rates, well, let me lock up longer term yields now. That has been the signaling power historically. We'll see. The problem here, Peter, and from an investor, I think a lot of times it's more noise than signal. Like from the economy, there's a signal there. The problem is this lag is hugely variable. What do you do
know,
with a signal that says it's so the yield curve first inverted here last October. Historically, we've seen 11-month lead time between that and first inversion and when the recession starts, all the way up to 50 months. So it could, we don't know when it's going to start. Yeah.
Yeah. I mean, instead of saying inverted yield curve, we could say like, when McDonald's sells more double cheeseburgers than Big Macs, because basically there's the economy expands and contracts, right? And we know that it does that for a lot of different reasons. Over time, it could be a terrorist event, it could be a tech bubble, it could be a housing crisis, whatever. And so look at the distance to the recession. So the question is there really a cause and effect happening here, or were many of these recessions going to happen anyway, right? So, but I think we're on the same page on this, which is even if it was precisely a predictor, it's not precise on when. And if you sat out the months in between, you'd wind up way behind as an investor. So it's from from a stock market and bond market perspective, as an investor, you playing it, you're going to lose based on this chart.
Yeah, it's pretty difficult. Usually the market this time around it was a little bit different because the market had already been falling before the inversion. So stocks peaked in the first week of 2022, then we're down significantly by the time this 3-month 10-year inverted. So every time is different. It's very difficult. Usually the market continues to run after this inversion. And then the question, of course, is, well, when do you buy back in if you're trying to use this as a timing signal? That's impossible, right, to answer that question. So from an investor, very difficult. But my main point in terms of the signaling power is interest rates are going up on the short end. And we saw the chart in terms of credit card debt, car loan, right, what it's done to the housing market. Typically, when interest rates get to be too much for an economy, then to withstand, then you see this inversion of the yield curve because people are expecting the Fed will have to then ease. So we'll see. We'll revisit this and see if it had signaling power. I suspect that it will, but I guess if it happens a few years from now instead of a few months, then we could say not very useful from that standpoint. Right. But last chart here, Strategic Petroleum Reserve. Everyone loves to debate this, and we just saw a record decline last year. So of course, gas prices went over $5 a gallon. Everybody talks about gas prices. That's the number one thing from an inflation standpoint that people are watching, because it's just a constant reminder. And it's the one price you really know. Most people don't know the prices they pay for other things, but you see it every time you go to the gas station. And we saw the U.S. selling off this Strategic Petroleum Reserve, their crude oil stock last year at a record pace. We're at the lowest level since 1983. Does this mean anything to you, Peter?
Totally worthless. All the stuff around oil is politics, and there's going to be a certain amount of oil that is used every month, and the only question is where is it coming from, and where is everyone buying it from? So not only is this worthless, boycotting other countries, oil is worthless, all of it. from my perspective, is meaningless.
Yeah, you and I agree on this point. It's all optics, right? So if the price of gasoline's going up and they're selling it off, it looks like they're doing something, right? So people want to always say, "Well, we're doing something, we're selling." But in terms of the actual supply of crude oil, it's not making any dent at all. There's 100 million barrels a day in global consumption, and here we are selling off a few million barrels a week. That's nothing. That doesn't change. I don't think people understand. This is a global market, determines the price of crude oil, and then thereby controls the price of gas that you pay at the pump. And so that selling that off isn't going to have a big impact. So 100% noise. All right. I think we covered a lot of ground there, Peter. We'll look back in in a few months to see what mistakes we made and the improvements for sure. But this was fun. Thanks everyone for joining us. For more content, subscribe to the channel, and we'll see you next time.